Welcome to the Hourly Podcast. In today's episode, Natalie Commons, a principal at RetroTax, discusses the Work Opportunity Tax Credit and its significance for businesses hiring hourly workers. She explains how WOTC can help offset turnover costs and provide financial benefits to employers. The discussion covers eligibility requirements, compliance challenges, the political landscape affecting the program, and barriers to its utilization. Natalie also outlines the steps for business owners to implement WOTC and the pricing models for services related to it, emphasizing the importance of education and support in maximizing the benefits of this tax credit program. Enjoy.
This episode is brought to you by JoJo, an AI virtual recruiter powered by Sprockets. Designed for the hourly workforce, JoJo works 24/7 to source, screen, and schedule interviews with the best applicants for your business. JoJo helps reduce employee turnover and time spent hiring so you and your team can focus on other important tasks. To learn more, head to sprockets.ai/JoJo.
Natalie, thanks so much for being on the podcast.
Absolutely. I'm thrilled to be here. Thanks for the invite.
Yeah. Well, you and I have known each other now for years. You run a business that I'm fascinated by that represents programs that can really help hourly employers, but not many people know about it. So give us a high-level overview of who you are, what the company is, and the work that you do. Then I'll start badgering you with questions about it.
Love it. Absolutely. So my name's Natalie Commons. I'm one of the principals at RetroTax. And what we do is we help business owners across the spectrum with employer-based tax credit programs. And the biggest one that people have maybe heard a little bit about is the Work Opportunity Tax Credit, or WOTC, if you're in the know. And what WOTC is, it's a new hire tax credit program. So it dovetails really nicely in the hourly worker space, because the companies that do best with this program are companies that are always hiring. And so the whole idea behind this program is to kind of level the playing field, but also kind of help to offset that really painful part of having an hourly workforce, which is turnover costs. And so the program gives you a income tax credit for hiring individuals that are in any one of about a dozen different targeted demographic groups. So if you're a business that's hiring people that have been on any kind of government benefit program like food stamps, cash welfare, they've been on unemployment benefits, then there's a potential tax credit for you as the business owner for bringing that person on board. So it helps to, level the playing field if you have people that have had issues either obtaining employment in the past, maybe they have, an off and on employment record, or just sustaining employment. And so that tax credit helps to offset that cost of turnover that you see as a business owner.
Love it. And is it federal or state-based?
Great question. So this is a federal program. There are kind of scattered state level programs as more and more states start to recognize the benefit of getting people off of, government benefit programs and back to work. And they're really seeing these types of programs help businesses, get over that hump to do so. We're seeing more adoption at the state level, but by and large, federal, which means it's open to any business nationwide, as long as you have a tax liability, there's an opportunity for you to explore this program.
Got it. And then give me some real dollars and cents here, right? Yeah. So I think we've all kind of gone through tax exercises where we get really excited. You do all these things and you find out that's actually not as big of an impact as you may like, right? Or that you were striving for. What is it through WOTC and some of the other programs that you've seen work for this space?
Yeah, so this program is really scalable, and the financial impact is really going to depend on the number of people that you as a business are bringing on board every year. So each individual, most of the target groups that we have available for the program are going to max out at $2,400 per employee, which, it's not $1 million, but it's nothing to sneeze at. Once you start adding it up, those numbers can have a real impact. There are a handful of target groups that go up to $9,000, $9,600. So those are going to be the ones that are a little bit fewer, further between. And that's going to be your disabled veterans. It's going to be your long-term family assistance recipients. But when you look at kind of what that means to the average business owner, like $2,400 is $2,400, but like, how does it add up? Without knowing really anything else about your business, like where you are, your industry, a good rule of thumb is 1 in 10 new hires is going to generate about $1,000 to $1,200 in credits. And that kind of averages out the issues where you have people maybe that came on board that would have qualified, but they worked 2 shifts and they never came back. And that helps to balance out those people that you do bring on board that are successful and that are going to max out at that $2,400 level. So that's a really easy rule of thumb when you're looking at this program to see if it's going to be worth it. And what you have to balance as a business owner is the work that you're putting in on the administration, which is where a company like mine can come in and help, because the compliance is a pain in the butt. The paperwork is a pain in the butt. But what we can do is we can take all of that burden off of the business owner, so you don't have to have somebody that's manually working those applications or dealing with that paperwork. And you can kind of take all of that back and forth off of your HR team or your recruiting team.
Got it. So give me some rudimentary numbers and maybe just a span or an estimate of a restaurant. Those are most of our listeners. So let's say you own 5 restaurants. You have 50 employees at each restaurant. So that's 250 people. Let's say 140% turnover. Let's say that's roughly 325 hires you have to make every single year. By your rule of thumb, just to make sure like everyone who's listening can kind of capture really financially what that might mean, is 10%, so that's 32 people may qualify for $1,200 every year. That's roughly $36,000 to $40,000 that they could earn back. Roughly is kind of what you
roughly
think.
Yeah, we're going to see, based on like demographics, like who you're hiring. Are the people that you're bringing on board mostly college students that are looking for a part-time job, or are you in a more urban area where you have a higher turnover rate? You're looking at more, like single working parents. Is this a part-time job? Is it a full-time job? That's where you're going to see the numbers either kind of go down or go up a little bit. But you really do see consistently year over year, those numbers are going to stay in that $30,000 to $40,000 range, and that's a income tax credit. It's not a deduction. So this is actually a reduction in that check you have to write Uncle Sam at the end of every year, which I know I hate doing, you hate doing. So if we can get that number down, it's always a boon to the business owner.
And so we keep talking about retention here, right?
Yeah.
So, I think there's probably guardrails, if I had to guess, to make sure that people aren't just employing people and then firing them after a week to get tax credit.
Yeah.
What are some of the parameters around what's required to actually get the WOTC tax credit?
A credit. So there are 2 things that have to happen for a business to get a tax credit. One, the employee, when they're coming on board with you, they have to complete a questionnaire. And that's basically what we use as the application to the state to determine whether or not that employee is eligible for the tax credit. Number 2, they have to work a minimum number of 120 hours. That's in their first year. So this is not an incredibly high bar, but obviously depending on your industry, you're going to have a number of people that don't meet that bar. And so as long as they work the minimum of 120 hours, you can use their wages for a credit. If they work at least 400 hours, and that's where this like retention piece comes in, then you can get a greater portion of those first year wages. And that's where you start to see us maxing out those wages up to the $2,400 and up level.
And it makes sense from the context of, if you look at why the federal government put this plan in place, it's to, in theory, and I don't want to misspeak here, but help people get off the government programming and into employment, and incentivize the company and the employee to stay longer term within the company, with the 120 hours scaling up to 400 hours to make that a little stickier, is what you're saying.
Absolutely. Because what you do see is that, if you take a step back and you look at this program from a 30,000-foot view, is that it is a revenue neutral program for the federal government. Because while they are awarding businesses tax credits, so it's reducing their revenue for administering this program, what they're getting on the back end is they're either reducing or getting people off of those benefits that they were paying out. So you get somebody off of food stamps because they're coming back to work. That's where the evening out happens. So, you do want to keep people on board long enough that there's actually an impact.
Yeah. And then we are 2 days. I mean, when this comes out, it's probably going to be past election day. But depending on who wins the election, do you anticipate there being potential changes to this program?
So the way that this and many other tax programs, tax legislation works is that it's authorized by Congress, honestly, in whatever term they decide at the time. So
Right.
there are some times where we get a year, there's sometimes where we get 5 years. Right now, the WOTC program is in effect for all new hires through 12/31/2025. And so that's just it's the current authorization period. Now, the great thing about this program, when it comes to sort of your ability to weather the changes in the political landscape, is that it's fairly bipartisan. There are a number of veteran target groups. And so that obviously that's going to help on both sides of the aisle. We tend to see the program go into what we call hiatus, meaning that they let it expire until December of the following year, and that's when they go through and they renew the tax. There's like a whole slate of programs that fall under tax extender legislation. This is just one of those programs. I think there is some potential for this program to be renewed before it expires at the end of 2025, because Congress is going to be dealing with the entire slate of tax legislation that is due to expire in 2025. But that would be me trying to predict Congress. And I think you and I and every listener knows that there's no way to predict what that group of people is going to do. So we'll see what happens.
One of the interesting things about WOTC, just from people I've talked to, data I've seen, is it's pretty underutilized across businesses. And very few people know about it. And as we just kind of outlined, the financial impact can be significant for a business. What's the gap? Like, why don't more people do it? Why isn't it just part of everyday work for most people?
It's the $1 million question. I think it's twofold. I think one, there's a lack of education. There is no marketing campaign by the federal government to get this program out there and to get businesses to participate in this program. I think post-COVID, we've seen an uptick in interest and appetite for the program, because once businesses, more and more people kind of got the idea that these types of tax credit programs existed during and after COVID, because you had programs like the Employee Retention Credit, you had PPP loans, and so it really opened up the conversation around tax credits and incentives. But really where you see the drop off is the implementation. So just like any government program, there's paperwork that goes along with it. There's resources that you have to have on the ground in your restaurant, in your business, to ensure that employees are filling these forms out, that they're completing the applications. And so that's where, if you don't know that there are companies like ours out there that can do the administrative work for you, you take a look at what's required, and it's an ancillary thing. It's not payroll. It's not required. You don't have to do this to run your business. And so if it's just one more thing, it always tends to just fall to the wayside, and there's just too much paperwork for, the everyday business owner to jump in with both feet.
Yeah. So walk us through, if I'm a business owner, I want to learn more about this and I want to implement it at my company. It's probably get in touch with you or a company like yours.
Yep.
Like what's the next few steps after that?
Yeah. So normally when we talk to a business owner who, this is their first brush with WOTC, and they're like, I don't know. I don't know what I don't know. The biggest question is, like, do you have a tax liability? Are you running at a loss, or do you have the appetite to utilize these credits? Now, the great thing about these credits is that for the majority of businesses in the United States are set up as some type of pass-through entity. So you're a sub S, you're an LLC, you're a partnership. That means that these credits flow through onto your K-1s. So they're reducing your personal tax liability at the end of the day. So, and the great thing about this is that even if you are like a startup restaurant, like this is you're running at a loss in year one, maybe even year two, these credits have a carry forward. So if you anticipate yourself being successful and having a tax liability moving forward, there's no reason not to start the program immediately, because you're going to have to pay taxes eventually. Death and taxes is the only two sure things.
Right.
So one, you want to know, do you have a tax liability, and are you comfortable generating credits if you're not currently paying taxes? Two, it's to take a look at your current HR processes, because there is employee involvement that's required in this program. It's not something that the employer can fill out for the employees. They have to answer these questionnaires. So normally what a business like ours will do is take a look at your current HR processes and say, where do we either have an existing integration where we can just pull this data, they can ask these questions within your HR platform, or where can we hook into your process? So if you are more of a startup business and you're like, hey, we're still doing things on paper, we kind of have this amalgamation of different processes where we're doing one thing over here and one thing over here, where can we hook into that process? Because we want as many employees filling out these forms as possible. Because if at the end of the day, you hire 325 people during the year, but only 100 people fill out the forms, like you've left so much money on the table. So let's figure out what that process looks like and how we can work directly with your team to make it as seamless as we can so that they're not doing any additional work. And then at the end of the day, as long as the employees are filling out the forms, you have somebody that's taking care of the back end process, which is talking to the states, submitting applications, submitting all the additional documentation. You're just kind of set it and forget it, and you're able to focus on the core business of what you do, while somebody like us can take care of all of that annoying compliance work. And then, we're just looking at payroll, we're looking at, the responses from the states, and we're generating the tax credit documentation for you.
Yeah. And I'm sure you don't mind the plug, but I want to make it I really want to try to help listeners understand the involvement someone would have to have with a company like yours. So
absolutely.
They meet with you. You ask them a bunch of questions, kind of do your analysis based on, are they eligible, how this could help. Then through companies like yours, they build a system to get the information automated in the HR platform.
Yes.
And then magically, companies like yours do the paperwork, help, and then work, I'm assuming, with the whoever that company currently uses for accounting or taxes, to, at the correct time, publish the paperwork that your team has built. Is that a good forensic?
That's a great assessment. And I think sometimes where we get confusion is people say like, oh, well, I have a CPA. That's great. You should have a CPA, or you should have an accountant. You should have somebody that's taking a look at your books. We are not CPA. We're not here to file your taxes. Companies like ours are not here to file your taxes. WOTC providers supply documentation and audit support to your CPA firm. We partner with CPA firms because this is really, even though it's related to taxes, this is an administrative effort. And so it's not something that most accounting or CPA firms handle, because it doesn't have anything to do with actually filing your taxes. It's the paperwork that you have to do to add in. It's just an additional schedule to add into your tax returns.
And then how does pricing typically look like, or how does pricing typically work for companies like yours? Is it, because I can imagine there being some challenges, because some years you might have $1,000 in credits, and some years you may have $300,000 worth of credits. So how do you think about that? And what are those conversations like with companies?
Absolutely. So the most common, most popular kind of pricing strategy for a WOTC administrator is a contingent fee arrangement. So, and really the reason why we charge this way is, like, if I look at it as a business owner, why would I pay for something upfront that I'm not going to see a benefit for right away? So you should be paying someone based on their success. There are, some companies, they charge upfront fees, and then, they'll charge kind of monthly, or you have some, especially if you're doing this through a big box payroll provider, they might be kind of charging you on a monthly basis for the work that they're doing as they go. But let's use a real life example. If we were to start working with a company, or if anybody is going to start working with a company now, it's November when we're taping this. We've got 2 months left of hiring, 2 months left of wages. That's not a huge amount of data to work with. So there's not going to be a whole lot there for any business that starts this program right now. So you're going to have very little there for your 2024 tax returns. So really, the majority of this benefit, you're not going to realize until spring of 2026 because it's going to be on your 2025 tax returns.
Right.
So, you know, the whole contingent fee arrangement works because if you've talked to a WOTC administrator and they're willing to do this program for you, it means they see a benefit for you.
Right.
Because if we start with somebody now and we're not going to get paid until March of 2026, like it's going to have to make sense. Like we're not going to work for 18 months and be like, I'm so sorry, it looks like this didn't work out for anybody. We're going to take a look at your numbers and we're going to say, hey, you're hiring the right kind of people. You have the kind of hiring that makes sense for this program. So this is something that you should consider.
Yeah. And how do you kind of talk to users and customers that have such a delayed gratification of the benefits, right? So like I'm assuming that this is likely just based on my experience of hiring tech is you make the hires, you do the work, and then you kind of just have to wait to see
You do.
how it goes.
Yeah.
And then at the end, you either, if the person gets to hour 100, if they get to hour 400, a lot of that's actually out of your control,
It
right?
is.
So, you have the meeting. I'm sure there's a lot of excitement. Then it's like time for the work, and then you start it, and then owner operator doesn't even benefit from it for a year at least. How do you kind
Yeah.
of care for that?
I think that something that I push really strongly with my team is like to set expectations appropriately. Like
Right.
I don't want anybody coming in being like, "This is going to change your life." when,
Yeah, yeah,
when it's no, it's not going to change your life next year. It might change your life the year after. But like, let's be realistic with the numbers that we're talking about,
Mhm.
because it doesn't benefit me by telling you I'm going to get you $100,000 next year if I'm not going to get you $100,000.
Right.
So like let's be realistic with the numbers, and at the end of the day, found money is found money.
Right.
You were going to hire these people anyway, and really their longevity with the company is only somewhat in your control as a business owner. If people have outside things that change, they're going to leave. They're going to leave. And so really what we're doing is we are making sure you're not leaving money on the table for doing the hiring that you were going to do anyway, for experiencing the pains of turnover that you were likely going to experience anyway. And really what this is that, year one, I always tell people, I'm like, it's not going to be as exciting as you think. But once you get into it, it's a program that builds and it becomes something that you can rely on year after year, just to bring down that tax bill a little bit. I know the estimated payment game is always, a pain
Yeah.
in the butt for people, but it's like, let's see what we can do to make that April payment a little less painful.
All right, cool. Well, now I'll ask you the same thing I ask every single guest as our last question, and we'll have
All
to
right.
continue the conversation another time. Maybe have you on after we have some listeners that use the WOTC tax credit can give some feedback, which I think would be
Yeah.
awesome.
Yeah.
So the question is, what was your first ever hourly job, or just first job, and were you fired from that job, or did you leave gracefully?
Oh, this is a great question. So my very first job was I worked behind the counter at a little like vegetarian cafe that was 3 blocks from my house because I was 15 years old and I
Love it.
couldn't drive yet. And so my parents told me that I needed to get a job. And so I walked down to this little like he was like a heat and go bakery, and thank God they took pity on me and hired me, and I worked there actually until they went out of business about a year and a half later, and I got to learn the skills of customer service and being able to talk to customers and learn how to work a cash register and
All that good
do all
stuff.
of that fun stuff.
Awesome. And if somebody wants to know more about you or the company, best place for them.
Yeah. Yep. So our website is www.retrotax, retrotax-aci.com. Happy to, reach out via our site, take a look at the programs that are on there. WOTC is not the only program we work with. It's just the biggest. Happy to have a conversation. And even if it's a program that doesn't end up working for you, There might be something else out there. There might be some state level things or geographic programs. I do anything we can to keep that tax bill as painless as possible, or relatively,
Love,
relatively as painless as possible.
love it. Well, thank you so much for being on the podcast, Natalie.
Absolutely, AJ. Thanks so much for having me.